Do you think that the Fed has already done most of the work it needs to do in order to tame inflation, or have some of the biggest hikes still yet to come?
Good morning, Wilfred. It's great to be on. We do think that the Fed has done really all they need to do to tame inflation. And the factor that almost no one is focusing on, and we're shocked by this, is the monetary base has already shrunk 15% this year, which is the fastest decline since the Great Depression. And if you follow the monetary theory of inflation at all, which I would recommend is important, at least when the Fed's radically changing the monetary base, then that means inflation should rapidly decrease. Maybe it'll be reflected more slowly in CPI. So we think that the background is good, but the Fed is more focused on the expectations theory of inflation. So we do think they'll be hawkish, and that's going to be an overhead hang on the market probably throughout this year. And then maybe next year they start to figure out that inflation is dropping pretty quickly.
And so, Jay, at the moment, the S&P 500's closed yesterday at sort of 4,140. What's your view of what fair value is?
We have a fair value model that's based on 10-year treasuries and a normalized risk premium. And that fair value has actually dropped by 300 points. So it was at 4,600 just a week ago. And then you saw a global bond meltdown when the Germans reported a almost unimaginable 5% increase in PPI, 37% year over year. That melted down the European bond market, hit our bond market. And so now our fair value is 4,300. And that's why we're cautious during this September, October timeframe where you don't have a lot of earnings reports, pretty fair valued market, and plenty of concerns about Fed policy, economic growth, and inflation.
And what about if things do start to pull back? Where do you think support gets found for the S&P 500? What sort of level would you be piling back in again?
Well, we're pretty bullish. You had a good segment about the European energy crisis. What almost no one ever discusses is this is very, very positive for U.S. Heavy industry, not just LNG and energy, but also fertilizer, chemicals, steel, all manufacturing that requires gas or electricity. So we think the U.S. economy is very resilient. So we think we'll bounce probably 3,800 will be in that range between now and earnings season in October. So we're more constructive than most people because we watch the energy markets and the fundamentals. We think fundamentals are good, technicals not so good.
You mentioned that you felt the Fed had done most of its work already, but also then the extent to which issues in Europe had infected U.S. markets. So do you think that U.S. markets can ignore a European recession or a worsening European outlook and what that does to European bonds or not?
Well, if the European bond market just continued to sell off, then that would be an issue for the U.S. A lot of U.S. investors don't watch the world bond market, but those two markets are highly correlated. But the U.S. market, bond market, is very, very attractive relative to the rest of the world. Japan's at 0. Germany's about 150. So we have very, very attractive rates. So we do think that the U.S. Treasury bond will stabilize right in this 3% area. And because growth prospects are dropping in Europe, we don't think that their rates will continue to skyrocket.